The next 24 to 48 hours are built for violent gold and silver swings because the calendar is about to force the market to show its hand. Not because a talking head said a scary word, not because a social feed found a new villain, because the plumbing is tight, the room is crowded, and the exits are smaller than they look. And the moment the crowd realizes it, price stops being a debate and turns into a mechanical process. That's the part most people miss. They watch the candles, they argue the headlines. Meanwhile, the real pressure is forming in one place. The short-dated options strikes where dealers are forced to hedge and where that pin can snap into a slingshot. Gold is sitting right under the psychological ceiling that makes everyone talk in round numbers, right around $5,000 an ounce, give or take a few bucks, depending on the feed you're looking at. Silver is doing what silver does when the regime shifts. It's not politely trending, it's exploding, printing triple digits, and dragging volatility behind it like a siren. The mainstream story will be simple. Risk, fear, inflation, geopolitics. Those are always available. But what matters right now is that a huge chunk of the market has positioned in a way that only works if price stays inside a narrow corridor through expiration. And that corridor is narrowing by the hour. Because if this one level breaks, the math changes. Here's the conflict you need to understand before you do anything with your own plan. One side of the market desperately wants this move to look like noise. An emotional overshoot, a retail frenzy, a headline spike, something that can be faded without consequences. The other side of the market doesn't care what it looks like. It cares what it forces. Dealers care what they have to hedge. Funds care what they have to rebalance. Shorts care what their margin desk will tolerate. Physical buyers care whether supply is available at a price that makes sense this week, not in some textbook average. And those are not opinions. Those are constraints. And that's why the next 24 to 48 hours can feel like a trap door. Let EES get one thing straight. When you see gold near $5,000 and silver north of 100, you're not watching normal volatility. You're watching a market that has shifted into a different gear. In January alone, gold has effectively stair-stepped from the low 4,300s to the high 4,900s, and silver has moved from the 70s into triple digits. That's not a quiet macro grind. That's a regime change with reflexive behavior baked in. And reflexive markets do something brutal. They make smart people look stupid for a day, and then they punish the people who got emotional the next day. And that's where the real pressure starts. So what's the hidden detail? It's not a secret memo. It's not a shadow cabal. It's not even a headline. It's the way the options market pins price into expiration and how that pin can suddenly flip from stabilizing to amplifying. In plain English, when a lot of options open interest piles up at specific strikes, especially round numbers, dealers who sold those options hedge their risk by buying or selling the underlying as price moves. Sometimes that hedging acts like a shock absorber. Price drifts toward a strike, hedging pressure nudges it back, and everyone thinks the market is calm. But when the strike gets overwhelmed, when price pushes through with speed, the same hedging turns into fuel. Instead of dampening it, accelerates. Instead of absorbing, it forces. And that S, when you get the kind of candles that make people swear the market is rigged, when really it's just mechanical. This matters right now because the calendar is not neutral. We were staring at a near-term expiration window where short-dated gamma matters more than anyone wants to admit. If you're looking at the February gold option cycle, the last trade date is right at the end of this week, S window, January 27th. That is the kind of date that quietly changes dealer behavior. Not because dealers wake up and decide to be villains, but because their book has to be managed into a deadline. And deadlines compress decisions. When time compresses, hedging becomes more aggressive. When hedging becomes more aggressive, price can whip around violently even if the broader thesis is still right. That's the trap. And the next detail is what flips the whole setup. Let's walk the mechanism cleanly, because if you understand this, you stop being surprised by the violence. You can still get hurt, but you won't be confused. An option has delta, how much it moves relative to the underlying, and gamma, how much that delta changes as price moves. Near expiration, gamma gets sharp. That means small price moves can force large hedging adjustments. If dealers are short calls in size and price rises toward those call strikes, their hedges can require buying more as price rises. That's the classic reflexive loop. It's not emotion, it's math. Now flip it. If price drops hard through a zone where dealers were long gamma or the strike distribution changes, hedging can force selling into weakness. And that's where those sickening flushes appear out of nowhere. Same market, same day. Two very different outcomes depending on where the strikes are and how fast price moves through them. Now zoom out and notice the second layer. This isn't just gold. It's gold and silver at the same time, with silver acting like the accelerant. Silver's market depth is thinner, its volatility is higher, and it tends to overshoot. When silver starts moving like this, it doesn't politely stop at resistance. It runs through levels, triggers stops, triggers hedges, triggers more hedges, and suddenly the narrative catches up after the move is already done. That SY we're seeing people argue about whether this is a bubble while the tape is printing. But that's not the part that matters. What matters is what the move forces participants to do in the next week. If you want proof this isn't just a cute story, look at the proxies where participation shows up immediately. The big ETFs are a window into behavior. GLD and SLV just printed eye-watering moves in volume because when volatility expands, participation doesn't just increase, it changes shape. People who don't trade metals suddenly buy a ticker. Funds that done chase suddenly need exposure because their benchmark and their risk model changed. And the options market around those tickers becomes a mirror of the futures market stress. This is why you can get days where price seems to levitate into the close and then gap on the reopen. It's not magic. It's flows meeting thin liquidity. And thin liquidity is the underrated part of the next 24 to 48 hours. Weekend gaps matter, not because Sunday is cursed, because liquidity is not continuous. Futures reopen into a different set of participants, different risk limits, different spreads, and sometimes different intent. If a level is going to break and hold, it often happens when liquidity is uneven. That's why you see the ugliest moves at the least convenient times. And that why anyone who tells you just place a tight stop and relax, is not respecting the structure of the market right now. Because if this one level breaks, the math changes, and your stop becomes a market order in a vacuum. Now let us talk about the other side of the conflict. The people who keep insisting this is just speculation. Could there be speculative behavior? Of course, when prices move this fast, speculation always shows up. But it's lazy to stop there because you're missing the supply chain and institutional demand mechanics that make these markets uniquely stubborn. Gold supply does not respond like copper supply. Silver supply does not respond like a tech stock float. When prices rise, the supply response is slow. Mining lead times are long. Refining capacity is not instant. Recycling helps, but it doesn't flood the market overnight. So when demand surges, whether that demand is central bank reserve, diversification, private wealth hedging, ETF inflows, or industrial procurement, you can get a sustained bid that doesn't care about your favorite oscillator. And that's where the real pressure starts. Here's a clean way to frame it, without conspiracies. There is paper pricing, futures, options, derivatives, and there is physical reality, bars, coins, industrial demand, vault inventory, delivery logistics. Most days, those two are aligned enough that you can pretend they're the same thing. During stress, they diverge. Not because someone is evil, but because paper markets can create exposure instantly while physical markets have constraints. When the desire for certainty rises, the willingness to hold a paper promise can fall, and the market has to reprice that preference. That shows up as premiums, as delays, as unusual spread behavior, as intense demand at certain delivery times. You don't need to claim manipulation. You just need to understand incentives and constraints. Now add the calendar again. Delivery windows and first notice timing matter because they determine when certain participants must act. Not everyone can roll forever. Not everyone wants delivery. Some do, some don't. Some are forced to clean up positions into deadlines because their mandate or their risk policy requires it. When those deadlines cluster near month end, you get a special kind of instability, a market that is both trending and mean reverting, sometimes in the same day. That's why the next 24 to 48 hours can produce a vertical spike and a brutal pullback, and both can be consistent with the bigger story. The next detail is what flips the whole setup. So what is that detail in practical terms? It's the reaction at key levels, not the levels themselves. Everyone will scream 5,000 for gold because it's a human magnet. Everyone will stare at 100 for silver because it's a human magnet. But the market doesn't care about human magnets. It cares about whether those magnets sit on top of heavy option strikes, whether dealers are short or long gamma around them, and whether the tape accepts or rejects those prices when liquidity is uneven. In other words, does price break above and stay bid, or does it spike and slam back? That single difference determines whether hedging becomes fuel or becomes a break. Because if this one level breaks, the math changes. Let's talk ranges in context, because you need to feel how stretched this is without turning it into superstition. Gold pushing up from roughly $4,325 at the start of January to nearly $4,190 by January 23 is a massive monthly move. Silver pushing from roughly $71 to above $103 is even more extreme, and that's exactly why silver is the volatility engine here. The market is telling you something. The marginal buyer is not price sensitive in the way you were used to. When marginal buyers stop caring, price doesn't discover value, it discovers constraints, and constraints get discovered in bursts. Now the obvious counterpoint, and we are going to put it on the table because trust matters. Parabolic moves can snap back hard. Silver especially can retrace an uncomfortable percentage without violating the longer-term thesis. Also, macro can surprise you. A sudden dollar spike, an unexpected rates repricing, a policy announcement, a geopolitical de-escalation, anything that shifts real yields expectations or risk sentiment can hit metals fast. And when you're in a high gamma environment, the move can be amplified. So the correct way to approach this is not guaranteed upside. It's high probability volatility with a clear mechanism. But that means you have to think in scenarios, not fantasies. Scenario 1 is the controlled pullback and retest. In this scenario, gold flirts with that $5,000 zone, maybe pokes above it, then pulls back into the prior breakout area, somewhere in the high 4,800s to low 4,900s, depending on how the tape prints, and then buyers step back in. Silver in this scenario might back off from triple digits, retrace toward the mid to high 90s, shake out late longs, and then stabilize. What confirms this scenario is simple. Pullbacks get bought quickly, spreads calm, and the market holds higher lows. The trend signal stays intact. The noise is the whip. But that's not the part that matters. The part that matters is whether the pullback is controlled or whether it turns into forced selling. Scenario 2 is the continuation squeeze with gap risk. In this scenario, price doesn't give you a polite retest. It rips. Gold pushes through the big round numbers, silver keeps running, and the move feeds on itself because hedging requires buying into strength, shorts are forced to cover, and late buyers chase because the market refuses to come back. What confirms this scenario is also simple. Price holds above the key magnet levels into the close and reopens strong after liquidity breaks, especially around weekend or overnight sessions. You'll see it in how quickly dips are erased. You'll feel it in the tape. And that's where the real pressure starts. Now the hard part. This is where most viewers get manipulated. Volatility is a psychological weapon. Even if the thesis is right, the path will try to break you. The market will do three things to you if you let it. First, it will tempt you to chase strength right when the short-dated hedging is peaking. Second, it will punish you with a sudden flush that feels like the top, precisely to shake you out. Third, it will resume in the original direction, leaving you either out of position or revenge trading. That cycle is how most retail accounts die in commodities. Not because they were wrong, because they were unplanned. So here's the psychology shield, and I want you to actually use it. Separate trend signal from noise. Trend signal is higher highs and higher lows on meaningful time frames, supported by structural demand and macro regime. Noise is the intraday whip that exists because liquidity is thin and hedging is reflexive. In a high gamma window, noise gets louder. If you treat noise like signal, you will overreact. If you treat signal like noise, you will underact. Your job is to decide, before the move, what invalidates your thesis. Not what scares you, not what makes you angry, what breaks the logic. Because if you don't define invalidation, the market will define it for you at the worst possible time. And invalidation isn't it went down. Invalidation is the mechanism stopped working. For example, if we're saying dealer hedging and positioning are fueling upside into a key expiration window, then the invalidation signal is a failure to hold above key magnet levels after expiration passes, combined with sustained selling that doesn't get absorbed. In other words, if price can't reclaim and hold the breakout zones, and rallies get sold hard instead of bought, that's a different regime. If that happens, you don't get stubborn, you get adaptive. Because if this one level breaks, the math changes. Now, let's make this even more concrete. What should you watch in the next week, and especially in the next 24 to 48 hours? Three things: the calendar, the close, and the retest reaction. The calendar means you note the deadlines that force action, like that near-term gold option expiration window around January 27th. You don't need to memorize every contract code. You just need to know that as expiration approaches, gamma can dominate, and after expiration passes, the market can either deflate or reposition. The close means you pay attention to settlement behavior. If you see persistent strength into the close near key strikes, that can be a tell that hedging is pushing price in a direction that will require follow-through the next session. If you see spikes that slam back before the close, that can be a tell of rejection and defensive positioning. And the retest reaction means you stop obsessing over whether a level was touched and start watching whether it was accepted. Acceptance looks like time spent above a level with dips bought. Rejection looks like brief spikes and sharp reversals. Now let ES address the elephant that skeptics always bring up. But isn't this just retail FOMO? Retail participation may be part of it, sure. But retail doesn't single-handedly push global precious metals into a multi-month, multi-standard deviation move unless larger forces are aligned. The larger forces can be macro regime expectations, rates, currency confidence, geopolitical hedging. They can be institutional positioning, ETFs, derivatives. They can be central bank diversification. They can be industrial procurement. The point is not to pick one villain or one hero. The point is to see the stack, mechanics plus flows plus constraints. When those align, markets don't politely revert because you think they should. And that's where the real pressure starts. Let's stack the proof in a way that respects reality without pretending we have perfect data. 1, the chart structure is undeniable. Gold has been making higher steps and printing fresh highs into late January, hovering near $5,000. Silver has not only broken round numbers, it has accelerated, a classic signature of regime shift. 2, the options calendar is a real date-stamped constraint. Short-dated options and expirations concentrate hedging flows. The closer you get, the more sensitive the market becomes to small moves. 3, the participation proxies are screaming. Look at how GLD and SLV behaved, outsized daily changes and heavy volume. That's not just a sleepy store of value trade. That's a market being repriced in real time. 4, the physical signals you can observe without any secret access, dealer sites and retail channels, have been warning about high demand, delays, and stress in processing. That doesn't prove a shortage by itself, but it does prove demand pressure in the real world, which tends to show up when confidence shifts. 5, the macro narrative environment is supportive even if you hate it. When investors believe real yields may fall, when currency confidence wobbles, when geopolitics stay hot, gold and silver become not just hedges, but alternative collateral in the mental model of institutions and individuals. That changes behavior, and behavior changes price discovery. Now, if you're still with me, here's the part that matters most. How this plays out around the $5,000 zone for gold and the 100-plus zone for silver is not about fair value. It's about whether the market is pinned or freed. Pinned markets feel like they're glued. They hover around a strike and frustrate both sides. Freed markets feel like they suddenly remember gravity can work in reverse. They gap. They run. They make you doubt your screen. If price is pinned into expiration and then freed, the next 24 to 48 hours can be the transition from controlled to chaos. And that's where the real pressure starts. So what levels matter? I'm not going to throw 20 lines at you like a horoscope. You need a few fulcrums. For gold, the psychological magnet is $5,000. The nearby support zone is the recent breakout and consolidation band in the high 4,800s to low 4,900s. If gold breaks above $5,000 and holds it into a close and then reopens strong, that's a strong confirmation for squeeze behavior. If gold spikes above $5,000 and then slams back below and repeatedly fails to reclaim it, that's a warning that the market is using the level as a liquidity trap. And that's not bearish forever, but it is bearish for your next 24 hours if you're chasing. For silver, the magnet is $100, and the immediate reality is that it already ran through it. That means $100 can flip from resistance to support, and the market will test it like it tests every emotional level, often in the most disrespectful way possible. If silver holds above $100 on pullbacks, the squeeze case stays alive. If silver loses $100 and can't reclaim it quickly, you can get a fast air pocket drop into the mid to high 90s as hedges flip and late longs panic. Again, that doesn't kill the long-term narrative by itself. It tells you about the short-term structure. Now you might be thinking, okay, but what do I do with that? Here's the clean answer. You don't trade because you're excited. You trade or you position because you have a plan for both scenarios. In the controlled pullback scenario, the opportunity is in patience. You let the market do the shakeout, and you watch whether the retest holds. You avoid leverage that can't survive a normal silver move, because a normal silver move right now is not small. You focus on where the mechanism should re-engage. Buyers defending prior breakout zones, volume stabilizing, and the tape refusing to stay weak. In the continuation squeeze scenario, the opportunity is in respecting gap risk. That means you don't assume you'll get a perfect entry. It means you avoid, I'll just buy the dip when the dip might not exist. It means you understand that in a squeeze, the market can go further than logic before it ever comes back. But it also means you respect that squeezes end violently, so you don't size like a hero. You size like someone who wants to be around next month. Because if this one level breaks, the math changes. And that's the last piece, risk framing. Price can whip around violently even if you're right. That sentence should be tattooed on every metals trader's brain. Being right on direction, but wrong on path, can still destroy you. So the practical shield is position sizing and time horizon clarity. Are you a short-term trader trying to capture the 24-48 hour volatility? Or are you a macro watcher who wants exposure to a regime shift and can tolerate the noise? Those are two different games. If you mix them, you'll get emotional. Now let's talk about why the other side will try to suppress or deny the move, not by manipulating price with a lever, but by manipulating interpretation. When gold and silver rally this hard, you will see a flood of narratives designed to make you second guess. It's a bubble. It's retail. It's already over. It's irrational. Sometimes those critiques will be partially true. That's the trick. They don't need to be entirely false to be effective. They just need to hit you right when volatility spikes and you feel regret. Your job is to return to mechanism. Did the market hold the key zones? Did post-expiration behavior confirm or deflate? Did dips get bought? Did the tape accept the new range? If yes, the story is noise. If no, you adapt. That's it. Now, let me give you a simple what happens next week roadmap that actually respects the calendar. First, watch the reopen and the overnight sessions. If gold and silver open strong after a liquidity break, especially around weekend or thin hours, that's often a sign that the bid is not just speculative day trading. It can be position building or hedging that doesn't care about slippage. Second, watch the behavior into the close as we approach that expiration window. Strength that persists into settlement in your key magnets can hint that hedging is pulling price. Rejection into the close can hint the market is setting a trap. Third, watch what happens right after expiration. Markets often change character after big expiries. If the move was purely gamma-driven, you can see volatility compress and price sag. If the move was gamma-assisted but fundamentally bid, you can see the market hold the new range and continue. That difference is everything. Fourth, watch silver relative to gold. When silver leads aggressively, it signals risk appetite within the metals complex and often indicates the move has speculative energy. When silver collapses while gold holds, it can indicate a cleanup of excess leverage without killing the gold thesis. That relative behavior is a tell. Fifth, watch the simplest tell of all, how fast dips are bought. Fast dip buying means someone is accumulating with urgency. Slow grinding weakness means the market is not under immediate pressure and you can get a deeper retest. And here's the micro detail most people forget. Volatility itself will be used against you. Big green candles make you chase. Big red candles make you bail. That's how the market transfers exposure from patient hands to emotional hands. Don't be the liquidity. Be the person who waits for confirmation, sizes appropriately, and refuses to make decisions in the middle of a spike. Now, I'll say it plainly. The next 24 to 48 hours are not about whether you believe in gold and silver. They're about whether you respect the structure that produces violent moves. Gold near $5,000 and silver north of $100 is not the place to improvise. It's the place to execute. If you want a single metric to keep your head straight, it's this: acceptance versus rejection at the key magnet levels, especially into the close and after liquidity breaks. If gold holds above the round number zone and keeps printing higher lows, that's confirmation pressure. If it repeatedly fails and spends time below, that's caution. If silver holds $100 as support and refuses to stay below it, that's squeeze behavior. If silver loses it and can't reclaim it, expect a violent shakeout. Because if this one level breaks, the math changes. And for the skeptics in the back, here's the respectful version of the argument. Yes, this move could be late stage. Yes, corrections can be brutal. And yes, narratives can run ahead of reality. That's why we use scenarios. That's why we define invalidation. That's why we respect volatility. The point isn't to be bullish forever. The point is to read the structure and trade the constraints, not the emotions. Here's the subtle truth that separates pros from tourists. In markets like this, the goal isn't to predict the next candle. The goal is to know what the next candle will force. If price breaks above a heavy strike zone into expiration, dealers hedge, shorts cover, volatility expands, and you get momentum. If price fails and collapses through the zone, hedges flip, stops trigger, and you get a flush. Same headlines, different mechanics. And that's why the next 24 to 48 hours are so dangerous and so revealing. So if you're watching this like a community that values mechanics over noise, here's your checklist, clean and simple. Identify your key magnet for gold and silver, identify your retest zone, decide your scenario bias based on acceptance or rejection, decide your invalidation point based on mechanism failure, not emotion. Size so you can survive a normal metals whip in this regime. And then let the market show you which path it's taking. Because the market is about to do something that will make half the crowd feel brilliant and the other half feel betrayed, and both feelings will be premature. The only thing that matters is what holds when the calendar forces the hand. And in the next 24 to 48 hours, that hand is being forced.